Mm. Right, friends. Uh, so in the last class, we have completed chapter 1 and 2. We started with chapter 3. This chapter 3 consists of 3 units. Unit 1, the concept of money demand. Okay, so why there is a demand for money, and the unit 2, supply of money, and unit 3, monetary policy. So now the concept of demand. Here, why there is a need for money. So the need for money is what for transaction purpose. Then the next is what transaction purpose in the sense for buying goods and services. The next purpose is what for precautionary purpose. For example, some unforeseen situation happens. Then I need to have the liquid cash in my hand to handle that unforeseen situation. So that is what we call it as precautionary motive. Then the last is what we call it as speculative motive, speculative purpose. Sir, whether I need to keep money in my hand or I need to invest in security. So which I need to do it. So the classical approach. So here we are going to discuss 5 theories. One is what the pre-Keynesian development of theory of money, that which deals with the classical approach, neoclassical approach, then the Keynesian theory of demand. The post-Keynesian theory is what inventory approach. One second. So the post-Keynesian theory, inventory approach to transaction balance, Friedman restatement of quantity theory, demand for money as a behavior towards risk. So classical approach, which states that demand for money is for the transaction purpose. We call it as QTM, quantity theory of money. So how much money required, which is based on money in circulation and how many times which has been circulated. So that is what we call it as velocity of circulation. For example, 100 rupees is there. If that 100 rupees has been transacted with the 10 people, then okay, it will be 1000. Sir, this 1000 rupees used to buy price per good is what 10 rupees, and the number of transaction which has been made is what 100. Then this 10 into 100 will be the 1000. So here the assumption is what, sir, whatever the money which I possess, which will be spent on goods and services. This is what the assumption of Irving Fisher. And in addition to that, I will not only use the currency notes, I will also use the bank deposits. Okay, that is what we call it as M dash. Okay, or the card. So in that case, that card is also the credit card or debit card, which is also used for transaction of for buying goods and services. So that will also be taken into account. So currency note plus the banking transaction will be put together, which will be used for transaction purpose. Then the neoclassical approach, which is also called as Cambridge approach. Here, sir, I will not use the entire money for transaction purpose. So the portion of money which will be used for transaction purpose. What will be that portion? Okay, that is what denoted by K here. Sir, if I earn 1 lakh rupees, I will not use the entire 1 lakh for transaction purpose. The portion of my money income will be used for transaction purpose, and the portion of the money income will be hold it as cash. So why I need to hold this as cash? Sir, there may be some uncertainty. That is what I said, for precautionary purpose. I may hold it as cash. So instead of spending that money, 1 lakh rupees, out of which 80,000 which has been spent, balance 20,000 which I am holding in my hand, okay, that will be considered for precautionary purpose. That will be considered for precautionary purpose. Clarity is there? So, sir, one more thing which we need to know, that whatever the income earned will not be spent immediately. So there will be a time gap between the receipt of money and use of money. Sir, I received a salary on first, but I will not spend the entire salary on the first day itself. It will be spent over a period of time. So that means, sir, on 10th I need to pay the rent. Okay, on 20th I need to pay the credit card bill. On 15th I need to pay the electricity bill. Like that, different outflow will happen on different date. Till that time you will hold it as the cash. Now, Keynesian theory. Okay, so John Maynard Keynes, we have already discussed. He is the father of what? Macroeconomics. So he said that the need for money, people hold money, in the form of cash for 3 motives. One will be the transaction motive. Okay, as we already discussed that, sir, whatever the income earned, out of which predominantly I will spend on what? Transaction or purchase of goods and services. This will be there. Then I will hold some amount for liquidity purpose. That is precautionary purpose. Then the balance amount, I need to decide whether to invest, in security or to retain that as a cash. That is what we need to take. That is what we call it as speculative motive or speculative purpose. Sir, in transaction motive, need of money increases when price of goods and services increases. So always the price and money demand for money will have direct relationship. So this is what precautionary motive is to meet the unforeseen situation. Okay, speculative motive. Okay, here, sir, people demand money. Okay, when interest rate are less. So when interest rate are more, they will not hold it money, rather than, okay, they will invest in the security. When they will hold it as money, okay, when the securities are not bearing, okay, a beneficiary interest, then in that case, okay, I will rather invest in bond. Okay, instead of investing in the bond, okay, I will retain that as a cash. So some amount of money you will set aside for what? Investment. But when you will invest, when that bond is bearing, okay, more interest compared to the market interest rate. For example, 1,000 rupees, okay, is the face value of the bond. The current rate of interest is what? 10%. One second. Current rate of interest is what? 10%. The maturity period, 3 years. Normal or critical rate of return is what? 8%. Sir, this current rate of interest is what? The interest which is paid by the bond which you purchased. But whereas the market rate of interest, that is normal return on investment, will be 8%. So that means normally I will get 8%, but when I purchase this bond, I will get 10%. Okay, in that case, whether you will invest in bond or not. Okay, sir, you will invest in bond. Why? Because see, the value of asset, which is nothing but present value of future cash flow. Okay, so today you have invested 1,000. Now in year 1 you will get 100. So that has been discounted to year 0. That value is what? 92.59. Then year 2 you will get 100. Year 3 you will get 100, and also you will, okay, maturity period of the bond is what? 3 years. Then third year you will get the money back, 1,000. So if I discount all this, okay, cash flows in today's term, it will be 1,051. Sir, 8% is what? Normal return on capital, normal return on investment, whereas my bond is giving 10%, then, okay, I will invest in the bond. I will invest in the bond. Okay, in order to maximize the income as well as the wealth. So here I am getting two benefit. One benefit is what? The interest. Another benefit is what? The capital gain. So when your bond rate is more than the normal rate of investment, then you will invest in bond. That means you will not hold money in your hand. It will be meant for what? It will be invested. Sir, If it is meant for investment, you are holding in your hand, then it is called as speculative purpose. But the moment you invest, okay, then the amount will not be there. Okay, so amount will not be there for speculative motive. இன்வெஸ்ட்மெண்ட்டுக்காக பணம் கையில வச்சிருந்தா அப்ப ஸ்பெகுலேட்டிவ் மோட்டிவ்காக பணம் கையில இருக்கு, டிமாண்ட் ஃபார் மணி. ஆனா நீ எப்ப பாண்ட்ல இன்வெஸ்ட்மெண்ட் பண்ணிட்டியோ அப்பயே உன்கிட்ட பணம் இருக்காது. அப்ப இன்ட்ரெஸ்ட் ரேட் அதிகமா இருந்ததுன்னா பணத்தை நீ என்ன பண்ணுவேன்னா பாண்ட்ல இன்வெஸ்ட்மெண்ட் பண்ணிடுவ, அப்ப உன்கிட்ட பணம் இருக்காது. அப்ப interest rate increases, demand for money decreases. Inversely related. இதே சார் interest rate decreases, my bond is fetching only 10%, but whereas okay, the normal return on capital, normal return on investment is what, 12%. Okay, so please change this as 12%. Okay, so it is not 8 year, it is 12%. Now, if that be the case, sir, when I discount the future cash flow, in today's term, it will be 951 rupees. That means you bought this bond for 1000 rupees, which you think that you will get 100 rupees in the first year, second year, third year. Okay, in the last year you will get the investment back. But my market, my normal return on capital employed, which gives me 12%. That means there will be a capital loss. So, will you invest in bond? No. You will hold it money for, okay, better investment. So, when interest rate falls, okay, demand for money increases. Demand for money increases. உனக்கு நீ நிறைய போர்ட்ஃபோலியோ ஆஃப் இன்வெஸ்ட்மெண்ட் பாக்குற, அதுல இருந்து உனக்கு ரிட்டர்ன் கம்மியா தான் வருது. எதை காட்டணும்? நார்மல் ரேட் ஆஃப் ரிட்டர்னை காட்டலும் உனக்கு ரிட்டர்ன் கம்மியா தான் வருது. அப்ப நீ என்ன பண்ண மாட்டேன்னா இன்வெஸ்ட்மெண்ட் பண்ண மாட்ட, அதுக்கு பதிலா என்ன பண்ணுவேன்னா கையில காசு வச்சுட்டு இருப்ப. அப்ப interest rate decreases, or I can say that your bond rate is less than normal return on investment. Okay, then in that case you will not invest, you will hold it as money. Then there will be a speculative demand for money. அததான் கிராஃபிக்கலா இங்க போட்டிருக்கோம். This is what I said, that there is an inverse relationship, okay, which results in downward sloping curve. Post-Keynesian development in the theory of demand. Sir, here I need to take into account interest, okay, as well as the brokerage for converting the money into securities. Okay, that also need to take into account. Sir, for example, the normal return on investment which comes to 6%. But whereas I am getting the return on investment from bond which comes to 6.5%. For converting this money into bond, for which I need to pay the brokerage. Okay, which comes to 1%. Then in that case, 6.5% minus 1%, my net benefit is what? 5.5%. Sir, instead of investing okay, in bond, I can retain the amount as cash. ஏன்னா எனக்கு பேங்க்ல போட்டாலே எனக்கு 6% கிடைக்குது. நான் செக்யூரிட்டிஸ்ல போடுறேன் எனக்கு அதனால 6.5% கிடைக்குது அப்படின்னு நினைக்கிறீங்க. ஆனா 6.5%க்கு நீங்க 1% brokerage வேற பே பண்ண வேண்டியதா இருக்கும். அப்ப அந்த brokerage பே பண்ணிட்டு உங்களோட net benefit okay which is not equal to what normal return on investment, then okay not equal or less than normal return on investment, then okay it is not worth to what interest in the bond. So as I said, the interest and demand for money will have inverse relationship. Price and demand for money will have direct relationship, that is positive relationship. Transaction cost, the brokerage cost, okay, increases, then the demand for money for conversion cost which is high, converting the money into bond, the cost is very high. Okay, then in that case I will retain as money rather than okay bond. But that will also have what direct relationship, that is positive relationship. Okay, negative relationship na inverse relationship, positive relationship na direct relationship. Clarity is there? Milton Friedman approach. Here, sir, we need to consider the equity share. Okay, that is the permanent source of income providing assets. Okay, for example, house property, which gives the okay a permanent source of income. Equity shares, which gives dividend. Okay, then in that case, what we need to do, for example, the normal return on investment is what 8%, but whereas my equity shares which gives me 10%, then in that case, sir, the face value of the share is what 100. Okay, 100 on which dividend 10% will be given. So 10 rupees will be the dividend divided by what will be my market return on investment, okay, or the normal return on investment, which comes to 8%. 10 divided by 8%, okay, where the equity share price will not be 100, it will be 125. So this is what given by the Milton Friedman approach. Okay, here also they said that sir, demand for money positively related to price level. Okay, then it is negatively related with the interest rate, and it is also influenced by the inflation. Sir, when inflation rate increases, then automatically the price will also what happen? Increases. Then there will be a increase in demand for money. Then demand for money as behavior towards aversion of risk, which is given by Tobin, Baumol and Tobin. Sir, as an investor, we need to have a portfolio of asset. That is, you need to have a safe set of asset. Sir, I need to invest some amount in the form of equity, some amount in the form of government security, some will be in the form of debentures. Okay, so there need to be an optimum portfolio of money which need to balance the risk and return. That is trade-off between the risk and return. Higher the risk, higher the return. But at the too much of risk which results in negative return. So அப்படியும் அதாவது ரொம்ப ரிஸ்க் எடுத்து நமக்கு வந்து நஷ்டம் ஆகிறதுக்கு எந்த அளவுக்கு ஒரு calculatable risk need to be taken so that I need to be in a position to earn the maximum return out of the speculative demand for money. So my portfolio of asset which need to consist of liquid cash as well as bonds. So it need to balance between both liquidity and profitability. Sir, நான் எல்லாத்தையும் இன்வெஸ்ட்மெண்ட் பண்ணிட்டேன் சார், கையில காசே இல்லை சார், அதுவும் தப்பு. சார், நான் எல்லாமே காசா பீரோல வச்சிருக்கேன் சார், எதுவுமே இன்வெஸ்ட்மெண்டா இல்லை சார், அதுவும் தப்பு. ஸோ ரெண்டுத்தையுமே ப்ராஃபிட்டபிலிட்டி, லிக்விடிட்டி ரெண்டுத்தையுமே பேலன்ஸ் பண்ற மாதிரியான அசெட் இருக்கணும். You need to have the portfolio of asset. So with this, we have completed chapter 3, unit 1. Now, concept of money supply. So as we discussed, why there is a need for money. So need for money is basically for that three purpose. Transaction, precautionary, speculative purpose. Now, who will be the supplier of money? Okay, and how it is supplied. That is what we are going to discuss in Unit 2. So what are all the different sources of money supply? Measurement of money supply, determinants of money supply, concept of money multiplier. Different source of money supply which is done by central bank. So central bank of India will be called as what? Reserve Bank of India, RBA. RBA is empowered to issue currency notes, which is called as primary source of money supply, which we call it as fiat money. This fiat money, which is based on the guarantee given by the government, that is based on the government securities and foreign exchange reserve, gold, which we call it as minimum reserve. Based on this minimum reserve, currency notes will be printed. For example, if you are having 500 crores as your reserve, that is the reserve in the form of gold, forex and securities, then based on this 500 crores, okay, this is what we call it as minimum reserve, based on which RBI will print the currency notes. There will be a concept called as money multiplier. This 500 rupees, 500 crores amount, sir, money multiplier is what? High-powered currency multiplier. Assume if it is 5 times, then 500 crores reserve, which used to print 2,500 crores currency notes. Rupees 2,500, 500 rupees worth of currency notes. So this printing of currency notes, which we call it as fiat money. And the commercial bank, in addition to that, they will create the money, okay, which is called as credit money, which is called as credit money. So source of money which is created by both the central bank as well as commercial bank. Then, sir, how to measure this money supply? Sir, money supply deposit with the public. Okay, who is mean by public? Household, firm, institution, except the producer of money, that is government and banking system. Government includes both the central government and state government. Banking system includes RBI and all other commercial banks, which are accepting, okay, CASA deposits, that is current account and saving account deposits. So M1, sir, there are two old monetary aggregates which we call it as M, new monetary aggregates NM. So here again, sir, currency and coins with the people, demand deposits, okay, which are repayable immediately, plus other deposits with RBI. That is the commercial bank will have deposit with the RBI, which we call it as a cash reserve ratio. Then M1 plus a saving deposit with the post office saving bank account. Then M1 plus net time deposits. See, the M1 and M3, the difference is what? M1 will be the immediate obligation for the RBI to settle that amount. So, which is, see, currency note, which is almost called as the promissory note. Okay, I promise to pay the bearer a sum of rupees, which is the undertaking given by the RBI to the person who are holding that currency note. So whenever we go and ask, okay, RBI to give the forex in place of Indian rupee, then the RBI need to what in a position to give that money back, give the forex or the gold. So that is what the immediate liability. We call it as narrow money. M1 will be called as narrow money, whereas M3 will be called as broad money, because which includes time deposit. That means immediate liability as well as I'm having some liability which are having a time space. For example, fixed deposit maturing after 3 years. Then in that case, okay, so we call that as what? Time deposits or term deposits. So that is what which is dealt in M3. Sir, even today, post office serving as a bank in so many villages. So we also need to take into account post office savings. So that is what dealt in M4. So new monetary aggregate. New monetary aggregate, sir, one thing which is called as reserve money. Reserve money, which is a monetary base or high-powered money. As I already said, sir, based on, it is a minimum reserve. Based on this minimum reserve only, the currency notes will be printed by the RBI. Lower the minimum reserve, lower will be the printing of currency notes. Higher the minimum reserve, higher will be the printing of currency notes. So there will be a direct relationship. So NM1, here again same thing, currency with the public, demand deposit with the banking system, and the other deposits with RBI. Demand deposit means CASA, okay, current account and saving account, which are the immediate obligation of the commercial bank. Then NM1 plus short-term time deposits, which are maturing within a year, which will be included in NM2. Sir, which are having a long-term time deposits, then that will form part of NM3. In addition to that, okay, there are post office saving deposits, which we call it as liquidity aggregate. Okay, so NM3 plus this liquidity aggregates, which is a post office saving banks account. Okay, then term lending financial institutions, then okay, public deposits of non-banking finance companies, NBFC. For example, there are so many NBFCs, City Financials, Bajaj Finserv, where they are also accepting deposits. Then all that that is other than banking system, who are all okay there, that will also be taken into account. Then I will altogether my new monetary aggregate plus liquidity aggregate will be there, called as, okay, the money stock or money supply in India, that will be calculated, okay, once in 15 days on a fortnightly basis. This is one way of computing the money supply. The other way of computing the money supply, okay, is what based on the analysis. Sir, if the money supply want to increase, okay, then if monetary base increases, then money supply will increases. So there will be a direct relationship between monetary base, that is high powered currency, reserve money, and money supply. Okay, so money multiplier, which is nothing but money supply divided by monetary base. For example, 2,500 crores is what money supply. Monetary base is what 500 crores. Then money multiplier will be 5 times. Always multiplier will be in terms of times. Stock of high powered currency. That is what I said, that supply of more high powered currency. Okay, so what happened? My money supply will increases. So it is directly related. Reserve ratio. See, reserve ratio, for that we will discuss this. There is one more concept called as credit multiplier. Sir, if a person deposit ₹1,000 in bank, then bank deposit liability will be 1,000. Bank will not okay, keep that safely in the locker. They will lend that. When they lend that money, they can't lend the entire 1,000 rupees. They need to maintain the reserve, okay, which is instructed by the RBI, and balance can only be lent. So, for example, reserve ratio, okay, is what 10%. That means 900 rupees will be kept as reserve with RBI, okay, which we call it as a reserve ratio, okay, 10%. Then 100 rupees will be with RBI or with the bank in the form of liquid asset, okay, that we call it as cash reserve ratio. When I maintain the cash balance with RBI, then it is called as CRR. Sir, when I maintain in the form of liquid asset, then I will call it as SLR. Okay. So the CRR and SLR put together 10%, that means 100. So out of 1,000, I will maintain 100 rupees as a reserve. Then balance 900 rupees will be lent it as loan. Again, sir, this loan will not be given in the form of cash. This loan will be given in the form of check to a party, okay, who need that loan. What party will do? Party will deposit this check into the another bank. Then another bank, when they accept this check, then that will be the deposit. And this deposit on which I need, that bank will maintain, okay, reserve of 10%, and balance will be given as loan. Like that, sir, the next, okay, person who gets the loan, he will deposit in another bank. 10% will be kept as reserve. Balance will be what given as loan. Like that, if I add all the loan given, it will be 10 times of the initial deposit. That means which comes to 10,000 rupees. How I got that 10 times? Credit multiplier or deposit multiplier, which is equal to 1 divided by 10%. 1 divided by 10%, which comes to 10 times. That means initial deposit, which is in the form of cash, fiat money, which is created by RBI, central bank. The balance 10,000 rupees, which is created by commercial bank, which I will call it as credit money. So total money supply in an economy, which comes to 11,000. 1,000 rupees initial deposit plus the credit money 10,000, which comes to 11,000. Now assume instead of the reserve ratio 10%, if it is going to be 5%, then credit multiplier will be 20 times. So when credit multiplier, when reserve ratio decreases, if it is 20 times, then 20,000 can be created. So lesser the reserve ratio, more will be the money supply. Same way, instead of 5%, reserve ratio is what? 20%. Then credit multiplier will be 5 times. So that means 5,000 can only be the money supply into an economy by commercial bank. So that which reduces what? Money supply. So higher the reserve ratio, more will be the money supply. Higher the reserve ratio, less will be the money supply. Lesser the reserve ratio, high will be the money supply. That is, reserve ratio and the money supply are inversely related. Supply of money and reserve ratio are inversely related. Sir, higher reserve, for example, say ratio of excess reserve to deposit. This is the behavior of the commercial bank. Now the commercial bank, lending rate, which is more than the reserve ratio rate, then what they will do, they will give it as loan. என்ன சொல்லுது, கடன் கொடுக்கிற ரேட்டு ஆர்பிஐல நான் பணம் வச்சிருக்க ரேட்டை விட, இல்ல என்ன சொல்றது, நான் கோல்டுல இன்வெஸ்ட்மெண்ட் பண்ண ரேட்டை விட எனக்கு அதிகமா வருது. அப்ப கமர்ஷியல் பேங்க் லோன் கொடுக்கும். ஆனா இல்ல சார், எனக்கு அந்த அளவுக்கு ப்ராஃபிட்டபிளா இல்ல சார், எனக்கு என்ன சொல்றது, கடன் யாரும் வாங்க மாட்டாங்க, அப்படியே இருந்தாலும் எனக்கு இன்ட்ரெஸ்ட் ரேட் ரொம்ப கம்மியா தான் சார் கமர்ஷியல் பேங்க்குக்கு கிடைக்குது. அப்ப they will not lend money, they will invest that money in the reserve, which I will call it as excess reserve ratio, So excess reserve ratio is inversely related to interest rate. Interest rate increases, excess reserve ratio decreases. Interest rate decreases, excess reserve ratio increases. That over and above the CRR, SLR, that's excess reserve ratio. RBA 10% தான் மெயின்டைன் பண்ண சொல்லியிருக்கு. ஆனா எனக்கு lending rate கம்மியா இருக்கிறதுனால instead of 10%, I will invest 20 or 30%. Okay, since I am not getting that much interest from lending. So that is the inverse relationship between excess reserve ratio and interest rate. Sir, deposit outflow. Sir, immediate liability for the commercial bank. உடனே பணம் திரும்பி கொடுக்கணும். அப்ப நான் யாருக்கு லோன் கொடுக்க முடியும்? திரும்பி கொடுக்கிறதுக்கு தான் கரெக்டா இருக்கும். அப்ப when your deposit repayment outflow which is going to increase, then instead of giving loan, I will maintain that as a reserve. So directly related. More the deposit repayment, more will be excess reserve ratio. Less the deposit repayment, less will be the reserve ratio. Then the public, behavior of public. Sir, if public rather holding it as cash, if they deposit it in bank, then the bank will create bank will give loan that which create investment. So money supply will what happen? Increases. But when people hold it high currency, when they are holding more currency notes, then supply of money will decreases. Higher the currency ratio, less will be the money supply. Lower the currency ratio, low holding of currency notes. பணமா வச்சில்லாம பேங்க்ல டெபாசிட் பண்றோம். அப்ப supply of money increases. அதே மாதிரி time deposit அதிகமா இருக்கு. அப்ப bank will have time to lend money. Money supply, credit money supply will what happen? Increases. So I ratio, time deposit, demand deposit ratio, I, then I money supply. Okay, if the time deposit, demand deposit ratio is low, then there will be a lower money supply. Effect of government expenditure. Sir, when Reserve Bank lends to government by way of ways and means advance, that is what WMA, or the overdraft facility, then which results in generation of excess reserve, excess balance of the commercial bank with RBI. See, the commercial bank will buy the government security for maintaining as a reserve. When the government issue the government security, RBI will sell the government security, commercial bank will buy the government security. Then the excess money will be taken out by the RBI. So we have already discussed this credit multiplier. One second. So now the third unit is what? Monetary policy. The objectives of monetary policy to attain the price stability, that is to overcome the inflation and deflation, full employment, optimum utilization of economic resources, by which I need to attain the high economic growth. There need to be a debt management, moderate long-term interest rate, okay, that is interest rate stability, exchange rate stability, balance of payment equilibrium, okay, that is the forex receipts and payment of foreign currency, okay, which need to be what equated. Then adequate flow of credit to the productive sector, efficient market for the government securities. So interest rate channel, sir, when RBI increases the interest rate, cost of capital increases. When cost of capital increases, investment and spending will decreases, aggregate demand will decrease, aggregate output and employment will decreases. This will happen at the time of inflation. Okay, to overcome the inflation, the rise in price is due to aggregate demand greater than aggregate supply. Now, sir, I need to control the aggregate demand. How can I control the aggregate demand? Aggregate demand need to be controlled by controlling the income and investment. So when interest rate increases, okay, the cost of capital, that is the lending rate, will increase. The producer will not invest. When the producer is not investing, then okay, he can't produce the goods. Okay, when he is not producing the goods, when there is no income, there won't be a demand. Sir, the downward, this interest rate decreases, increase inflation, decrease deflation. Okay, here we follow the cheap money policy, where the cost of credit will be cheap, then investment will increases. When investment increases, production increases, aggregate demand will increases, okay, which will match with what supply. So deflation, which results in fall in price. Now I need to bring back that fall in price. Okay, so for which I need to what reduce the interest rate, exchange rate. Sir, domestic currency rate increases. For example, sir, $1 from 80 rupees, it decreases to 75. So value of domestic currency, when price of forex increases, value of domestic currency decreases. When price of forex decreases, value of domestic currency increases. So always the price and value of rupee, price of forex and value of rupee will have inverse relationship. Now value of rupee increases. Imports will what happen? Increases. Export will decreases. Aggregate demand will decrease. Sir, 80 rupees which falls to 75. That means, sir, I will be very happy if I'm going to be an importer. So I will import the goods. But as an exporter, okay, I will lose 5 rupees per dollar. For example, 3 months back, I raised the foreign currency invoice for $1,000. At that time, the dollar price is what, 80, but now reduced to 75. Okay, that means I thought I will realize 8,000, but I will realize only what, 7,500. So I will not happy to produce goods for exports. So when exports falls, import rises. Okay, then I can't achieve what, trade equilibrium. There will be a trade deficit. Okay, which will have adverse impact on national income. Same way, sir, exchange rate increases. That means value of rupee decreases. When value of rupee decreases, import decreases, export will increases, aggregate demand will increases, which results in increase in national income. Sir, if RBI increase the reserves, then availability of loan will decreases. When availability of loan decreases, investment and spending will decreases. Okay, when investment and spending decreases, aggregate demand will decreases, which results in decrease in national income. That is aggregate output and employment, which is nothing but national income. Same way, reserve decreases, then quantum of money available for credit will what happen? Increases. Loan availability increases. Investment increases. Then income increases. When there is an increase in income, demand increases. Then there will be a production, increase in production. Asset price channel. Sir, equity shares price falls, wealth falls. Okay, then investment will also fall, because the people will not interested to invest in shares. Okay, so investment falls, then there will be a fall in aggregate demand, which results in fall in aggregate output and employment. Same way, sir, increase shares, which results in increase in wealth maximization, then investment will increase. Okay, everyone happy to increase in investment, then there will be increase in demand, because income increases, demand increases, then demand increases, to that extent production increases, which results in increase in employment and income. So there are two types of policy: expansionary monetary policy, okay, where I will reduce the interest rate, exchange rate, quantum channel, asset price channel. Okay, contractionary monetary policy. That means I need to contract the money supply. So increase the interest rate, increase the exchange rate, increase the reserve. Inflation increase. At the time of inflation, contractionary monetary policy will be followed. At the time of deflation, expansionary monetary policy will be followed. So this we already discussed that, sir, higher the reserve ratio, lower will be the liquidity in the system. So what are all reserve ratio? Reserve ratio consists of two things: cash reserve ratio, statutory liquidity ratio. Cash reserve ratio will be maintained with the RBI as percentage of net demand and time liabilities. That is, whatever the deposits accepted by the commercial bank, in that the portion will be kept with the RBI in the form of cash reserve ratio. It will not bear any interest. Okay, it will be an interest-free deposit with RBI. Okay, so the ratio will be given by, the rate will be given by the RBI. Now, statutory liquidity ratio. Sir, this will be maintained in the form of cash, gold, and investment. Okay, the investment again will be in the form of treasury bills given by the government. Okay, state government loans, then other instrument as notified by RBI. This is also based on the demand and time liabilities. Okay, this will not be maintained with RBI. This will be maintained in the commercial bank itself. Again, CRR, SLR increases. CRR, SLR decreases, availability of loan increases. Sir, 1,000 rupees deposit. RBI reduces CRR from 4% to 3%. Okay. SLR from 19.5% to 18%. That means earlier 1,000 rupees is the deposit, 40 plus 195, which I need to keep in the form of liquid asset and with RBI. So amount available as loan will be 765. But now it has been reduced to 3% and 18%. So total which comes to 21%. So 1,000 into 21%. So which comes to 210. 210 will be in the form of reserve ratio. Balance 790 will be available for loan. CRR, SLR rate which has been given. Repo rate is a rate at which a bank borrow funds from RBI. Sir, if commercial bank need money, they will borrow from RBI by giving the securities, government security, okay, as a collateral and get the money. Okay, they will give the government security, discount that government security and get the money. So that is what we call it as repo rate, repossession rate. Okay, this repo rate, which is also called as policy rate. Reverse repo rate. Okay, this rate where RBI borrow money from commercial bank. Sir, for example, there is a commercial bank, okay, which is not having any lending base. Whatever the deposit they accept, okay, they will give it to RBI and get the interest rate. That interest rate will be called as reverse repo rate. So bank borrows from RBI will be called as repo rate. Bank lends to RBI will be called as reverse repo rate. Okay, repo rate, which is also called as liquidity adjustment facility rate, policy rate. So repo rate and reverse repo rate will be increased to control inflation. The repo rate increases, bank will increase their lending rate because their purchasing rate increases, borrowing rate increases. So their lending rate will also increase. Okay, when lending rate increases, people will not get a loan. When people are not getting, the producer are not getting loan, they will not invest. When they are not investment, okay, they are not investing money, okay, they will stop their production. When they stop their production, their income will decreases. When their income decreases, the excess of demand over supply, which results in rise in price, okay, that excess demand will be reduced. Sir, when increase in reverse repo rate, sir, when reverse repo rate increases, bank is having an option now whether to give loan or to deposit with RBI. Okay, bank, commercial bank, instead of giving loan to general public, they will deposit with RBI. Since RBI reverse repo rate is very high, okay, so what will happen? The excess okay, liquidity from the market will taken away by RBI by increasing the reverse repo rate. So always inflation, increase repo rate, increase reserve ratio, increase reverse repo rate, deflation, decrease. Bank rate, earlier bank rate is used as a policy rate. But now bank rate, okay, bank rate is the rate at which commercial bank rediscount the securities with RBI. முன்னாடி எப்படி இருந்ததுன்னா கமர்ஷியல் பேங்க் அவன் பப்ளிக் இல்ல ப்ரொடியூசர் லோன் வாங்கும் போது கொடுத்த கொலாட்ரல்ஸ டிஸ்கவுண்ட் பண்ணி ஆர்பிஐ கிட்ட இருந்து கமர்ஷியல் பேங்க் லோன் வாங்கும். சோ அதுக்கு அந்த லோனுக்கு ஒரு இன்ட்ரெஸ்ட் ரேட் தான் பேங்க் ரேட். இப்ப ஆர்பிஐ கிளியரா சொல்லிடுச்சு, நீ யாரோ அசட்டை வச்சு லோன் வாங்க கூடாது, உன்னுக்கு இருக்க அசட்டை வச்சுதான் நீ லோன் வாங்கணும். So the rediscounting of bills which has been discontinued, that is what given in the third point. Bank rate is a penal rate. Sir, normally repo rate 4% na bank rate கொஞ்சம் அதிகமா இருக்கும். Why it is a penal rate? Penal rate ன்றது ஏன்னா ஆர்பிஐ சொல்லுச்சு நீ ஒரு ரிசர்வ் ரேஷியோ மெயின்டைன் பண்ணணும்னு சொல்லிட்டு. நீ என்ன பண்றனா அந்த ரிசர்வ் ரேஷியோ மெயின்டைன் பண்ணாம, ஃபார் எக்ஸாம்பிள் 10% ரிசர்வ் ரேஷியோ மெயின்டைன் பண்ண சொன்னா, நீ வந்து சார் நான் 6% தான் மெயின்டைன் பண்றேன் அப்படின்னு சொல்லிட்டு மெயின்டைன் பண்ணினா, யூ ஆர் நாட் ஃபாலோயிங் மை இன்ஸ்ட்ரக்ஷன், தென் ஓகே I will charge you a higher rate of interest for lending. That's MSF rate, marginal standing facility rate. Bank rate and MSF rate are same. Policy rate, repo rate, LAF rate are same. Open market operation. Sir, RBI will be a person who sells government securities. So RBI on behalf of government who sells government securities, then when they will sell this government securities, sir, when there is a inflation, people are having more money. What people will do? People will deposit money with commercial bank. The commercial bank, in turn, they will buy the government securities. When they buy the government securities, RBI will sell the government securities. So, in order to take away or to wipe off the liquidity, RBI will sell government security to the commercial bank to take away the excess liquidity. When people are not having money, or when there is a recession or depression, deflation, where RBI buy back the securities, that is, they will give the money to the commercial bank, to invest in the market, by which liquidity will be there in the market. Market stabilization scheme, where they will use the foreign currency on the domestic liquidity. They will use the foreign currency into the market, for making the market more liquid, or they will take away the foreign capital inflows from the market, that is taking away the excess liquidity from the market on account of large capital inflows. So this monetary policy framework, which is the theory area, which you can go through on your own. So with this, we have completed chapter 3. Rahul? We will have the overview of chapter 4 in the next session, friends. So we will wind up today.